What if I told you that the real threat to your savings isn't just inflation or interest rates? There's a hidden force at work in our financial system called liquidity. And while few outside of financial circles track it closely, it quietly controls whether money keeps moving or suddenly stops. When liquidity dries up, even the strongest economies can face chaos overnight. For example, the Federal Reserve's assets exploded from $900 billion in 2008 to nearly $9 trillion at its peak, not just to fight inflation, but to keep the credit pipes from freezing. These warning signs show up before most people notice anything is wrong. Understanding how this system works beneath the surface is the key to spotting trouble early. Let's start by looking at how liquidity really moves through our financial system and why it matters for your money. Think of the financial system as a city's hidden plumbing, with money flowing through pipes that keep everything running behind the scenes. Liquidity is the water in those pipes, essential, but rarely noticed until something goes wrong. When money moves easily between banks, businesses, and investors, the system works smoothly. But if the flow slows or stops, the impact spreads fast. A good example of this is what happened during the 2008 crisis. Banks refused to lend, overnight rates spiked, and the Fed had to inject $1 trillion emergency plumbing to avoid collapse. That freeze wasn't just a blip. It was a warning of what happens when trust and liquidity disappear. One bank's hesitation quickly became everyone's problem, and the financial system nearly ground to a halt. Every day, money travels through specific pathways. Banks lend to each other overnight to meet short-term needs. Companies draw on lines of credit to pay their workers. Investors transfer funds between accounts and shift money into or out of different assets. Each of these actions depends on someone else having cash ready at that moment. These aren't just abstract transactions. They're millions of real transfers happening constantly, all relying on healthy liquidity. Central banks, especially the Federal Reserve, play a huge role in keeping these pipes clear. From under $1 trillion pre-crisis to about $8.9 trillion by 2022, the Fed's balance sheet ballooned. These weren't just policy moves, they were emergency repairs to keep money moving. Quantitative easing, or QE, is like sending in a crew to patch up leaks and reinforce weak spots. The Fed created new money to buy troubled assets, which freed up space on bank balance sheets and let the system breathe again. It lifted asset prices, gold and equities alike, and left long-term inflation impacts that remain debated. But these fixes, meant to be temporary, have stuck around, and the system never fully returned to normal. The problem is, traditional economic indicators don't show you what's happening inside the pipes. GDP tells you how much water is coming out of the taps, not whether the pipes themselves are corroding. Unemployment rates show how many people are using the system, but not if blockages are building that could stop the flow. That's why crises often catch even the experts off guard. They're watching the faucets, not the plumbing underneath. Even professionals sometimes ignore the details of liquidity. Traders focus on price swings. Analysts look at company profits. But the actual mechanics of how money moves get attention only when something breaks. This blind spot means many investors are left exposed when problems start to build. If you know what to watch for, you can spot early warning signs. When banks suddenly hold on to cash instead of lending, when overnight borrowing rates jump, or when normally easy-to-trade markets start seizing up, these are clear signals of stress. The pipes always show signs of strain before anything stops working at the surface. But here's the thing. Since 2008, we haven't just relied on those old pipes. We've poured even more water into them. The same financial infrastructure that struggled under pressure before now has to handle much, much more. Right now, the biggest strain on the financial system comes from the massive debt load that needs constant refinancing. Global debt has climbed to over $300 trillion, pulling the entire system under pressure. To picture it, imagine a city where every building's water bill must be renegotiated every week. Even if one deal falls through, the whole neighborhood feels it. That's how governments, corporations, and pension funds operate. They roll over old loans with new ones, always counting on someone else to provide the cash at just the right moment. The problem is, debt has grown much faster than the cash available to service it. Since 2008, global debt rose about 150%, while world GDP grew only 60%. Advanced economies have seen their debt double relative to liquidity, pushing the debt-liquidity ratio above its long-term, crisis-triggering threshold of about 2 to 1. This makes the system more fragile, because every refinancing cycle becomes a potential stress point. Debt doesn't just sit quietly on balance sheets. It needs ongoing attention, payments, rollovers, and the trust that lenders will keep showing up. For example, Japan's debt GDP at roughly 260% shows how even the safest creditors still bankroll unsustainable borrowing. The Bank of Japan has become the main buyer of its own government's bonds, keeping the system running mostly on trust and intervention. Low interest rates after 2008 made it easy for companies and governments to borrow more. U.S. government and corporate debt compound at rates near 8% annually, far outpacing nominal GDP growth. Many companies use this easy money to buy back shares or refinance old loans. Now, with higher rates, those same borrowers face much bigger bills. BBB-grade corporate bonds, the lowest investment grade, have ballooned to $3.7 trillion. If just a few of those get downgraded to junk status, it could trigger forced selling and sudden market stress. Pension funds add another layer of pressure. The largest 100 U.S. pensions face $1.6 trillion in unfunded liabilities. These funds need cash to pay retirees, so they're always selling assets. When markets drop, they must sell even more to cover losses, draining liquidity and amplifying any downturn. Rising debt service costs make things even tighter. The U.S. government now spends $1 trillion a year just on interest payments, more than it spends on defense or Medicare. Corporations face $500 billion in debt coming due in 2024, often at much higher rates than before. Every dollar spent on old debt is a dollar that can't go toward growth or investment. To cope, the financial system relies on complex engineering. Tools like collateralized loan obligations and interest rate swaps help spread risk. But they also add complexity, making it harder to spot where problems might start. Shadow banks, including private credit funds and fintech lenders, now handle about half of global lending outside traditional banks. These lenders don't have central bank support, so when liquidity dries up, they can disappear quickly, just like what happened in the crypto market crash of 2022. Because of these risks, many corporate treasurers are now hoarding cash. This isn't just caution. It's a reaction to the memory of 2008, when even healthy companies suddenly lost access to credit. But when everyone holds onto their cash, it reduces the flow of money through the system, making liquidity even scarcer. All of this means the system is under constant strain, and even a small disruption can have big consequences. When the pressure builds, everyone turns to the financial plumbers, the central banks, to keep money moving and prevent a breakdown. Central banks have to balance two jobs that often work against each other: keeping inflation under control and making sure money flows easily through the economy. Their official goals sound straightforward: price stability and maximum employment, but the reality is a constant tug-of-war. When inflation picks up, their playbook says to tighten the money supply, but when financial markets freeze up, they have to step in and add cash, even if that risks fueling more inflation. This tension explains why central bank policies can shift so quickly and sometimes feel unpredictable. You can see this balancing act in real-world crises. In September 2019, overnight repo rates suddenly jumped from around 2% to 10%. This spike happened because corporations were pulling cash to pay quarterly taxes, right as the government issued more treasury debt. Banks didn't have enough reserves to cover both needs, so short-term lending nearly ground to a halt. The Federal Reserve responded by injecting up to $75 billion a day into the system, acting as the emergency plumber to keep the pipes from bursting. A similar story played out in the UK in 2022, when volatility in government bond or gilt markets triggered margin calls for pension funds. The Bank of England had to quickly reverse its rate hikes and start buying bonds. This was a classic case of plumbing repairs taking priority over fighting inflation. Central banks often become lenders of last resort, stepping in to prevent broader financial damage, even if it means putting their inflation goals on hold. Since 2008, central banks have gotten used to doing whatever it takes to keep markets stable. The European Central Bank famously used those words in 2012, promising unlimited bond purchases if needed. The Fed stretched its own rules during the COVID crisis, buying corporate bonds and rapidly expanding its balance sheet. These actions all follow the same pattern. When liquidity dries up, the usual rules get set aside in favor of emergency measures. The main tool central banks use is buying assets, mostly government bonds, to inject money into the system. The Fed's balance sheet grew from about $1 trillion in 2008 to $4.5 trillion in 2020, peaking at $8.9 trillion in 2022. This massive expansion helped keep the system afloat, but it also created new risks. Markets now expect central banks to step in whenever there's trouble, which encourages riskier behavior and makes the system more dependent on official support. There are limits to how much central banks can do. Selling assets to fight inflation, what's called quantitative tightening, removes liquidity at the exact moment when debt is at record highs and needs to be refinanced. The Fed tried to shrink its balance sheet, reducing it by $1.3 trillion since 2022, but had to slow down when stress appeared in the banking system in March 2023. It's a tough spot. Drain too much liquidity, and you risk breaking something else. Meanwhile, private banks and money market funds have become more reliant on central bank facilities. Banks now park $3.3 trillion in the Fed's reverse repo programs each night, while money market funds depend on these tools instead of lending to each other. The system loses some of its natural shock absorbers when everyone looks to the central bank for help. Even when central banks say they're tightening, they still have to keep basic plumbing services running. The Fed's balance sheet is unlikely to return to pre-2008 levels, because today's debt loads mean constant support is needed to keep markets functioning. Every attempt to normalize policy tends to hit a wall as soon as markets show signs of stress. One strange effect of all this intervention is that the new money doesn't flow evenly through the economy. It often pools in financial assets first, lifting prices for stocks, bonds, and real estate before it ever reaches Main Street. This pattern can make markets look strong, even when the real economy is struggling, creating a disconnect that leaves many people scratching their heads. Let's break down why markets often rise even when the economy is in trouble. The 2020 pandemic was a perfect example. In April 2020, unemployment soared to 14.8% as businesses shut down across the country. At the same time, stocks dropped about 34% by March 2020, yet regained their losses within months as the Federal Reserve printed $4.5 trillion and pumped it into the financial system. This surge of liquidity hit markets first, not the broader economy. Liquidity always takes the path of least resistance. When central banks inject cash, banks don't rush to lend it to small businesses or consumers. Instead, they buy treasury bonds and other liquid assets. Hedge funds use cheap loans to make bigger bets. Corporations borrow at low rates to repurchase their own shares. These moves push asset prices higher, while the real economy feels left behind. The money ends up where it's easiest and fastest to deploy. The housing market shows this clearly. Even as the Fed raised rates from 0% to 5.5% since 2022, home prices in many areas kept climbing. Normally, higher mortgage rates should cool demand. But with institutional investors and cash buyers flush with liquidity, bidding wars continued, making homes less affordable even as economic growth slowed. Liquidity can override the usual supply and demand patterns. For investors, the there is no alternative problem became real. With treasury yields below inflation and bond funds losing real value, investors had no alternative but to buy stocks, driving valuations to price-to-earnings ratios near 38, well above historical averages. Pension funds and other big investors needed returns to meet their obligations, so they poured money into riskier assets. This constant flow kept prices rising, even when company profits or the economy didn't back it up. Traditional ways of measuring value start to break down in this environment. Corporate profit margins expanded while GDP was shrinking, something that usually doesn't happen without a lot of outside help. Analysts started using terms like financial repression to describe how forced investment choices distort the true price of assets. Markets stop reflecting the real economy and instead mirror where liquidity is flowing. The numbers tell the story. M2 money supply surged 300% since 2008 against only 85% GDP growth, feeding asset inflation. That extra money didn't just disappear. It chased after stocks, bonds, and real estate. For every $1 in economic growth, about $3.5 flowed into financial assets. This explains why household net worth shot up while wages barely moved. Companies responded by focusing more on financial engineering than business growth. S&P 500 firms spent $5.3 trillion on stock buybacks from 2010 to 2022, boosting share prices and earnings per share, even if actual business results lagged. Cheap debt made this possible, masking weak fundamentals. This pattern can't last forever. Either company earnings will need to catch up to high valuations, or liquidity will have to shrink. It's tough to predict exactly when things will shift. Japan's markets, for example, stayed elevated for decades despite slow growth. But when liquidity finally pulls back, the adjustment can be sharp. Some early warning signs are already visible. In 2021, insiders sold $50 billion in shares as markets peaked. Corporate debt defaults jumped 150% in 2023. Fewer companies are going public because private valuations are out of line with what public investors are willing to pay. These cracks suggest that even a flood of liquidity has limits. So, if you want to understand when markets might turn, it's not enough to watch headlines or economic data. The real clues are hidden in the plumbing, those obscure liquidity signals most people overlook. Instead of focusing on headlines or company profits, it's worth paying attention to the signals that quietly flash under the surface. These are the warning signs most people miss, but they're often the first to reveal stress building up in the system. One of the most important gauges is the TED spread. This measures the difference between what banks pay each other to borrow, or LIBOR, and what the government pays on treasury bills. In normal times, the TED spread stays low because big banks trust each other. But when that trust erodes, the spread widens fast. In early October 2008, the TED spread jumped from about 1% to over 4%, an unmistakable signal that banks saw each other as risky and were pulling back. It was a clear sign of trouble before the broader public caught on. Another key indicator is the LIBOR-OIS spread. This spread compares the cost of interbank lending to the expected path of central bank rates. During calm periods, it sits near 0.1%. But in March 2020, as pandemic panic set in, the LIBOR-OIS spread topped 1.4%. That spike meant banks were suddenly demanding much higher premiums to lend, even overnight, a sign of acute funding stress before the crisis hit the headlines. Repo market rates are also worth watching. These short-term loans are like the heartbeat of the financial system, letting institutions borrow cash against safe collateral. Normally, repo rates track closely with the Federal Reserve's target rate. But when something blocks the flow, rates can spike out of nowhere. In September 2019, overnight repo rates shot from 2% to 10%. This happened because cash was being pulled out for tax payments at the same moment a wave of new treasury debt hit the market. The Fed had to step in with $75 billion daily just to keep the system running. Today, some of these warning signs are flashing again. The spread between SOFR, which replaced LIBOR, and treasury rates has shown unusual, erratic widening, even with the Fed's ongoing support. This suggests there may be problems with collateral or underlying liquidity issues that aren't obvious if you're just watching stock prices or economic growth numbers. Why do these indicators matter? Because they show how quickly trust and liquidity can evaporate. When banks hesitate to lend to each other, or when repo markets need emergency help, it means the system is under stress that traditional metrics won't reveal until it's too late. Most of the time, these signals show up months before a crisis becomes front-page news. You don't need to be a professional trader to keep an eye on these. The TED spread and LIBOR-OIS data are available from sources like the St. Louis Fed and Bloomberg. If you see sudden, sustained spikes, it's a reason to pay attention. History shows that these ruptures in the plumbing often show up before a full-blown crisis. Recent events like the 2022 UK gilt crisis prove how quickly things can spiral. When pension funds faced margin calls, forced selling drove bond prices even lower, and the Bank of England had to act within days. This happened while economic data still looked fine on the surface, reminding us that liquidity issues can emerge suddenly and move fast. These warning signs don't always lead to disaster, but they do show when pressure is building. The system can look stable until, all at once, it isn't. Understanding these signals helps you to see how quickly things can shift, and why breakdowns rarely give much warning before they happen. Crises in the financial system often seem to come out of nowhere, but the reality is that they can unfold with startling speed once certain pressure points are reached. The entire system relies on confidence and smooth flows. When either breaks, the effects can be immediate and far-reaching. Lehman Brothers is a textbook case of how a crisis can erupt almost overnight. Despite months of concern about its exposure to subprime mortgages and high leverage, the firm continued to operate as usual until mid-September 2008. Then, in just 3 days, trust vanished. Counterparties stopped doing business, cash evaporated, and by September 15th, Lehman was forced to declare bankruptcy. The fourth largest U.S. investment bank disappeared within 72 hours, and the resulting shockwaves quickly spread through the global financial system. The collapse of long-term capital management, or LTCM, in 1998 happened on a similar but even shorter timeline. After Russia's August 1998 bond default, LTCM plunged into margin calls and nearly froze global markets within weeks. The fund's complex strategies and heavy leverage left it unable to unwind positions fast enough. The Federal Reserve had to step in and organize a bailout to prevent the crisis from spreading further. Both episodes show that when leverage is high and trust breaks down, failures can escalate in days, not months. Modern technology makes these events even more sudden. High-frequency trading algorithms now execute millions of trades per second. During calm periods, this can help with liquidity. But when markets turn volatile, these same algorithms can trigger massive sell-offs in seconds. The 2010 flash crash is a clear example. The Dow Jones Industrial Average dropped nearly 1,000 points in minutes before partially rebounding. Smaller flash crashes in other markets happen more often than most people realize, fueled by automated trading and thin liquidity. Cryptocurrency markets magnify this effect. These markets operate 24/7 with minimal regulation. When a large sell order or negative news hits, prices can drop 20 to 30% in hours. Automated trading bots and the lack of centralized intervention make these declines even sharper. While traditional markets have circuit breakers, crypto markets show how quickly liquidity can vanish and prices can spiral. Dealer balance sheet constraints also play a big role in how crises unfold. Banks and dealers used to act as shock absorbers, stepping in to buy assets during sell-offs. Today, regulations and capital requirements limit how much risk they can take on. When panic selling begins, they can't always provide support. The 2019 repo market crisis highlighted this issue. Dealers couldn't absorb a surge in treasury supply, causing overnight rates to spike until the Federal Reserve intervened. Stress in the repo market and collateral shortages are now some of the most reliable early signals of broader trouble. When the flow of short-term funding slows or collateral values are questioned, the system can seize up quickly. Payment systems add another layer of vulnerability. When Lehman failed, thousands of transactions froze mid-process, affecting everything from corporate credit lines to payrolls. Today, with most payments routed through a few clearinghouses, a disruption can ripple out in seconds. Financial systems are complex and interconnected, so failures don't build slowly. They tend to erupt once a critical threshold is crossed. Psychology adds fuel to the fire. When professionals spot trouble, they don't wait. They pull credit and sell assets, which can trigger the very crisis they hope to avoid. Fast communication and algorithmic responses mean panic can spread almost instantly. Because of all this, preparation matters more than prediction. You can't know the exact timing, but you can recognize the warning signs and take steps to reduce your own risk. Simple actions, like holding extra cash or having backup ways to access funds, can make a huge difference if normal channels freeze. This is why personal finance strategies need to account for how quickly systems can lock up. When the pipes burst, having your own safety valves in place can help you weather the storm. Let's look at what you can do to build that kind of resilience in your own financial life. Protecting your financial plumbing starts with making sure you have quick access to cash when you need it most. During a crisis, assets that usually seem safe can suddenly become hard to sell, or might lose value right when you need money. That's why experts recommend keeping 3 to 6 months' worth of essential expenses in cash or short-term treasuries. This is the core of a strong emergency fund, enough to cover basics like rent, food, and utilities if your income stops or you face an unexpected bill. It's not just about having money set aside, it's about having it where you can actually get to it. Cash and money market funds are the most reliable during a freeze. If you put your emergency savings into stocks, long-term CDs, or illiquid assets like real estate, you might find yourself unable to access funds without taking a big loss. Short-term government bonds, especially those maturing within a year, are a good option because you know exactly when you'll get your money back. Avoid locking up too much in investments that can't be quickly converted to cash. Your emergency fund size should match your risk. If you're the only earner in your household, work in a volatile industry, or have high medical expenses, aim for the higher end of the 3 to 6 month range. Think about what costs you absolutely can't skip. Housing, food, insurance, and medications. Discretionary spending like travel or dining out isn't part of this calculation. The 2008-2009 recession showed how job searches can stretch for months, so it's better to be prepared for a longer gap than you expect. How you store your emergency fund matters too. Spread your cash across 2 FDIC-insured banks and keep $200 to $300 in paper bills at home for situations where ATMs or online banking might be down. In 2008, some people faced withdrawal limits or delays when banks were under stress. Having multiple ways to access your money can help you avoid being caught off guard if one account is temporarily frozen. If you invest in private assets like real estate or private equity, remember, these can be especially hard to sell during a crisis. Balance these with extra liquid reserves. Even blue-chip real estate investment trusts, or REITs, dropped sharply in 2020 and were tough to sell at a fair price. The lesson: liquidity often disappears just when you need it most. Adjust your portfolio so more of your money is in places you can reach quickly. Move some funds from volatile stocks into cash or short-term treasuries. Diversify across asset types, but don't overdo illiquid investments. This way, you can handle bills or even take advantage of opportunities when others are forced to sell. Preparation is about structure, not prediction. You don't have to guess when the next crisis will hit. Instead, set up automatic transfers to your emergency fund, review your account access, and make sure your reserves still fit your current needs. Even small, regular steps build up over time. When financial systems show stress, those with liquidity aren't just safer, they can make the most of new opportunities. The ability to act quickly is what sets the prepared apart. So while the next crisis may begin quietly, your own planning can make all the difference when it matters most. As the Federal Reserve faces tough choices between inflation and financial stability, the outlook for liquidity remains uncertain. S&P projects Fed quantitative tightening will end by late 2025, after which central banks will likely return to active plumbing as rising debt maturities put more strain on the system. This means monitoring the right signals. TED spreads, repo rates, and interbank lending indicators will only become more important. Start building your own resilience now. Keep cash buffers, short-term treasuries, and reliable access to funds. Watch those liquidity gauges. Your financial safety depends on pipes you can't see. If you found this useful, hit like and subscribe for more deep dives into the forces shaping your wealth.